Aditya Khemka, fund manager of InCred Asset Management, joins in with his view on the healthcare pact. Aditya, before I go into earnings, just before you joined us, we were talking to Himanshu Baid of Poly Medicure. They've had a very successful QIP with some very solid hands like a Lighthouse, a Nomura, and SPI coming in. Expansion plans are looking ambitious over the next 3 to 4 years. Do you track Poly Medicure? Do you feel like this could be a stock that may potentially turn out to be a multi-bagger and should be on a strategic pharma allocation in one's portfolio?
Yeah, good morning and thanks for having me. Yes, we feel that medical devices as an industry in India has a lot of scope to grow. Obviously, the PLI scheme and the import substitution, China Plus One, these are the factors that will help the business to grow. Poly Medicure as a stock, we do not own it, hence we cannot comment much on it. But we feel that the opportunity is large and all the players in the space should benefit from the opportunity.
You should benefit from this opportunity. You do think it's a good space that one could consider investing in. Well, let's start with earnings now. And I just want to wrap up the Q1 earnings because most believe that it's been a good quarter. If you split it up between the international business, India business, the drop in raw material prices, healthcare has stood out. Tell me, what is your macro sort of takeaway from the first quarter and what are you expecting into FY25? I want a word on the US generic space as well because of the election overhang, or rather the outstanding election, impending election in the US. Pharma is one sector that could get impacted. So how would you strategically position yourself?
So we feel that the unbranded space in 1Q FY25 did exceptionally well. And, that's a space that we generally don't invest in because it tends to be very unpredictable and a low ROE business. But, truth be told, first quarter FY25 numbers were beyond our expectations in the space. However, we are not sure of the sustainability of such earnings that the space is reporting. We believe the next 3 to 4 quarters may be good in the space, but then the space would normalize. And once it normalizes, stocks which are more exposed to that space may not be doing as well as they have done in the past couple of years. So I think that's where, unbranded generics is probably at the peak profitability at the current time. And the stocks which are exposed to that are also trading at peak multiples. So when you have peak profitability married with peak multiples, generally that's a recipe for some difficult outcomes. So as investors, we tend to stay away from such spaces where we feel earnings are not sustainable and multiples are too high. So, that's where unbranded generics stand out. For us, we don't invest in that space as of today. We don't see any value in it, and we doubt the sustainability of the earnings. On the branded generic side, in the 1Q25 numbers were extremely good. Top line growth was good, volume growth was good, and margin expansion did happen. So, that's something we remain positive on. However, there are stocks in this space which have become extremely expensive, and that sort of worries us because, we don't want to invest in a good business model at any price. We want a price risk-reward ratio which is in our favor. So branded generics now we have become fairly selective in terms of, how we pick stocks in this space. On the API CDMO space, again, earnings remain lumpy. So some companies reported a great quarter, whereas other companies sort of, reported a benign quarter. But that tends to be the nature of the beast. It's a business that tends to be volatile between quarters and even between years. So, we don't try to sort of look at this business on a quarter-to-quarter basis. We look at it more from a year-to-year basis. So we continue to believe that CDMO as a space will do extremely well over the next 5 to 10 years. This is a mega trend which investors have to be aware of and have to play in the next 10 years. Hospital earnings were brilliant in the last quarter. Again, ARPOB growth was great. There was volume growth. However, many hospital stocks, especially the larger ones, have become prohibitively expensive. Some of them are trading at 65 to 80 times operating cash flow in terms of enterprise to operating cash flow. And that's a multiple we are not happy with. We do have a couple of hospital stocks in our portfolio, but these stocks tend to trade at 17 to 25 times their operating cash flow rather than the 65 to 80 times for the larger companies that we do not own. So we are again value oriented in the hospital space today because the larger names have become just too expensive to invest in today. Last but not the least, diagnostics. I think that's where the biggest positive surprise happened in the space. So diagnostics reported very healthy volume growth. Price recovery has happened. So, in the past, because of online platforms launching diagnostics, there was some disruption in pricing. That seems to be over now. and most diagnostic chains are taking price increases, so there has been a positive earnings surprise for us. And we still find many stocks in the diagnostic space which are fairly valued or below fairly valued. So that's a great area of interest for us because the earnings are improving and valuations are in our favor. So that's a space we are most bullish on at this stage. At a broader level, what we are seeing in the market space is that investors are rotating money from growth-oriented sectors to value sectors, and that which is where I think healthcare is finding favor today.
Yeah, Aditya, very detailed response there on how InCred looks at every segment of the healthcare space. Tamanna here. Let's just get into a bit of detail and minutiae of how that translates into specific stocks and sectors. Now, pharma seen as a defensive play has seen a fair bit of interest recently. So if I were to ask you, let me come to CDMO first, because you were most constructive on CDMO and you said that's a mega trend that you have to follow. What are the companies at the forefront of that mega trend in your view?
So in our portfolio, we have Jubilant Pharma, we own Hycal, we own Syngene in the space. And again, the reason why we choose these companies is because we want to be focused on companies that do CDMO for innovators and not necessarily just CDMO for generics, because we feel CDMO for generics is a more it's a more fragile business, and that business tends to be lower margin, lower ROE compared to CDMO for innovators, which tends to be higher margin, higher ROE businesses. So CDMO for generics is something we like to stay away from, and CDMO for innovators is where we put our money on to work.
Okay, let's come to the hospital sector, and you're absolutely right. Q1 has been good for the hospital space in a quarter which is traditionally not their best necessarily, but you're talking about valuations. Which do you think have now run up beyond valuations, and where do you still see some steam left to go in the hospital space?
So look, it's difficult for me to talk about what we do not own. So I will be talking about what we own. So what we own, valuations are reasonable. So we own Healthcare Global, which is a super specialty oncology focused healthcare chain. And we own Aster DM, which is again a South India focused multi-specialty, where again valuations seem to be very, very favorable for the investors.
Okay, so let's assume what you do not own is also part of the bucket of stocks that you think are richly valued. Just as we have a couple of minutes left, Aditya, I want to understand what are the policy-driven sort of headwinds that the pharma sector may face, because you're seeing a kind of a rejuvenation, but just recently, for example, the government has loosened up some of their imports on certain segments for various reasons, diabetes drugs, cancer drugs, etc. There are some companies who have pretty decent monopolies in this space. Do you see such policy headwinds going further, and which do you think are the companies that could get most impacted?
So look, in the pharma space, there are generally 3-4 types of regulations. Let's take them one by one. So firstly is obviously the domestic market price regulation that the government comes up with, and there are fixed dose combination bans that keep coming here and there. So that's always something that exposes branded generic companies to that kind of regulation. But within the branded generic universe, I think MNC pharma companies, the Glaxos, the Abbotts, the Pfizers, the Sanofis, they are more exposed to these regulations because they tend to have products which are on the higher end of the pricing spectrum. And therefore, when the product comes under price regulation, these are the companies which bear the brunt of, majority of the brunt of the price regulation. Coming next to another regulation that generally tends to happen is the US FDA issues, right, that you hear about. Now that generally impacts the unbranded generic pharma companies more than any other bucket. And the unbranded generic pharma companies again is a space where, we find regulatory challenges, we find margins are lower, we find ROEs are lower. So, that's a space that we completely avoid investing in. Although it's a large part of the index, it is about 50% of the index, like a Nifty Pharma index or a BSE healthcare index, but that's a space that we really want to avoid because this the risk reward isn't in favor of investors today. Another challenge that keeps happening is in terms of regulatory landscape is the ability to import or export, because government sometimes tends to put restrictions on import or exports because they want certain drugs to remain in the country, or they want the country to be self-reliant in matter of certain drugs. But that's always healthy for the industry. In the short term, it may lead to some cost pressures or growth challenges, but over the longer term, if the industry becomes self-reliant, is always better. We have seen historically, countries like China being hostile when times are tough. So we saw the COVID time. China was the first country to come up with a COVID vaccine, but they were the last country to sell the COVID vaccine to anybody else. So they weaponized the disease, they weaponized their ability to create a vaccine. India, on the other hand, was I think third or fourth to come up with a vaccine, but we were the first to give the vaccine for free to our neighboring countries. So the geopolitical dividend we earned during COVID was big.
Okay, I'm out of time. Sorry, Aditya. I'm just going to wrap up. I want to get your top picks. Let's give the viewers, a clear takeaway before we wrap the show. What would be your top 3 companies in the pharma space today? And would Divi's be on that list? I'm asking because of the kind of run-up Divi's has had.
Sure. So the top 3 positions that we have in our fund are Thyrocare, Jubilant Pharma, and Krishna Diagnostics.
Sorry, which was the first one?
Thyrocare Technologies.
Okay. Thyrocare, Jubilant, and Krishna Diagnostics. All right. We'll have to let you go, Aditya, but absolute pleasure speaking with you. Thank you so much for joining us.